Something fascinating just happened in Washington. The big banks held what many people in the crypto community are calling an anti-yield summit. And the whole thing really highlights the growing tension between the traditional financial system and the emerging world of digital assets. At the center of the debate is a simple question. Should people be allowed to earn yield on digital dollars? Banks say no. Crypto companies say absolutely yes. And that disagreement is now holding up major crypto legislation in the United States, including the proposed market structure bill known as the Clarity Act. Mexico what the banks are arguing. Representatives from the traditional banking sector, groups like the American Bankers Association, warn that if stablecoins are allowed to offer interest or rewards, people could move huge amounts of money out of banks. Mexico they argue that yield-bearing stablecoins would act like shadow bank deposits. Up to $500 billion or more could leave traditional banks if crypto yields are widely available. That shift could reduce banks' ability to fund mortgages, small business loans, and other lending. American Bankers Association, so their proposal is simple: ban any kind of yield or reward tied to stablecoins. Politico Pro, from their perspective, this is about financial stability. But from the crypto perspective, it looks a lot like protecting a monopoly. The crypto industry's view crypto companies argue that banning yield would basically freeze innovation. Stablecoins are digital dollars running on blockchains. And the crypto industry says users should be able to earn returns directly through digital financial infrastructure rather than through banks acting as intermediaries. Many in the industry see the banks' push as an attempt to preserve their control over deposits, prevent competition for savings, slow down the adoption of decentralized finance. In fact, critics have accused banking lobbyists of trying to turn pro-innovation legislation into something anti-competitive. AMB Crypto, why this matters for Bitcoin. Now here's where it gets interesting. Bitcoin itself doesn't rely on yield from banks or institutions. The whole philosophy behind Bitcoin is self-custody and monetary independence. This debate shows exactly why Bitcoin exists in the first place. Traditional finance runs on a model where banks hold your deposits, they decide the interest. Rates, they decide how your money is used. But in crypto, people are asking, why should banks be the gatekeepers of yield at all? Blockchain technology allows value to move and generate returns without a traditional bank sitting in the middle. The bigger picture, what we're watching right now, isn't just a policy debate, it's a financial power struggle. On one side, a $25 trillion banking industry that depends on deposits to fund loans and maintain its business model. American Bankers Association, on the other side, a new digital financial system built on blockchain technology that challenges that entire structure. And the question lawmakers have to answer is this: do we protect the old system, or do we allow the new one to compete with it? Final thought, from a Bitcoin perspective, the irony is hard to ignore. The banking system is arguing that people shouldn't be allowed to earn yield outside banks because it might weaken banks. But that's exactly the kind of centralized control that cryptocurrencies were designed to challenge. So whether you're a Bitcoin maximalist or someone exploring the broader crypto ecosystem, this debate is a reminder. The future of money isn't just about technology. It's about who gets to control it.